So welcome to the video. It's Finance for JCL. The purpose of this channel is to look at the long-term £1 million investment goal by 2050, ideally, and I'm looking for high-quality companies to invest in for that very long-term goal. Have a look at my recent portfolio update. I'm underweight in high-quality companies. So I'm looking to see whether PepsiCo is a good investment for my portfolio, long-term hold. Hopefully this will help you out as well if you're new to the company. Just to be clear, isn't financial advice, so make sure you do your own research and take your own professional advice as usual before you take any action. Hopefully this review will help you learn more about the company and also perhaps how I review stocks for my portfolio for the quality company angle. Let's start right now and review the company. Using the TIKR terminal here for most of my investing research for the numbers. I've just signed up to a subscription and it gives sort of 10 plus years, depending on which level you go for, of all the financial data. So it's really good to get a really good history of those numbers. If you like the look of it, I'll leave a link in the description below so you can check it out. First thing I'm going to be looking at is the quality of the company. Is this a company of high quality and therefore worthy of further research? So I'm going to the ratio tab, and the first thing I'm looking for is that return on capital employed. I want companies that are 20% plus, and we can have a look here across this region here, this highlighted row. Actually, not great colour, so I'll take that off. You can see the return on capital employed is just around about 20% in some years, and in the high teens in other years. So it's a good value, but it's just a little bit below the value that I'd want. Also want to determine their pricing power through gross margin. And if we head on over to the income statement, we've got the gross profit here, and the gross margins there are in the 50s percent most years. Very, very consistent gross margins. The company's got pretty good pricing power. I'm looking for 55% plus on this, so it's just about in that ballpark. And then going sort of down the balance sheet, going down the income statement, P&L, we're looking for the profitability of their operation, so operating income. And we've got here the operating margins there highlighted in blue. So in the mid-teens, 15, 16%. So decent, but not world-beating, not super, super good. I'm generally looking for around about 20 to 30% in that area. A little bit below again. Also looking at cash conversion, which I'll show you at the end, because that's a little calculation just to see how well they translate profits into cash. And even just perhaps an introduction, actually I should have started this really, but in the UK, there's plenty of brands here that those of you will recognise. Even Nobby's Nuts, which I was surprised about. I didn't realise they were owned by PepsiCo. And then internationally, there's plenty of big brands here you can see on their website as well. So this is a very large food and beverage company. So with that history and that quality point, it looks like a good company. So they're a good company, but I want to know, is there a chance of failure? So we'll look at the interest cover, debt to equity, and current ratio. So we've got the interest cover, the second row down there in blue, EBIT divided by interest expense, and it's actually dropped a bit recently. It's still good. It's not like they're going to fail, but we should be concerned by that drop off. And the debt to equity as well is certainly higher than the 100% that I would like. It looks like there is quite a lot of debt in the business. I'm also looking at the current ratio, the ability to pay short-term bills, and that has dropped off as well, below 1 in recent years. That's pretty disappointing. Although I don't think they're going to fail, the trend on some of these values is negative, and they're higher than the thresholds that I've got. Just over Simply Wall Street, because there's a dividend to consider as well. That yield is around 2.5%. At the line here that's going up across to the top right, that's the dividend share. So that's been consistently growing over time. About 10 years, it was 206, and we're now looking at 460, so over 100% increase in 10 years. And it's forecast to go to over $5 a share. As a percentage yield, which is the darker line, that's staying relatively constant. Payout ratio is okay, 63%. Forecast is that it will be 100%. So again, the dividend isn't likely to grow at exponential levels, but it's going to sort of tick up over time, but this sort of 100% future payout ratio is slightly concerning. So I've just brought up here my investing checklist, and that's available to members of the Patreon community. And I've got my previous reviews as well. Now, what I'm doing going forward, because I've upgraded my TIKR subscription, I'm looking at the 10-year and the 5-year trend in blue, and I've got like a RAG status in column G here. So if it's green, it's above the ideal level. If it's orange, it's between the target and ideal. If it's red, it fails. Now, red, could still be a good company. Like return on capital employed here, the average is 19% over 5 and 10 years. Yes, it's below 20, so it's red, but it's still a decent return on capital employed. All these numbers on the right, they're just the raw data, the raw numbers kind of pasted in for the calculation. So the quality side, it's 19%. The minimum one is 20, so it's red, but not terrible red. Gross margin, minimum one is 55, they're at 54, pretty close. Operating profit 16 versus 20, but ideally I want 30. Cash conversion has dropped in recent years to 86%. And again, the interest cover is 9 versus 14 to 16. Debt to equity is over double the percentage. Current ratio, though, is 1.02. It's actually below 1 for the last 4 years. And the free cash flow yield for valuation purposes is about 2.5% at the moment. I want sort of 5 to 6%, if not even higher. So PepsiCo is not a buy, even though it's a good company. There are some other factors I consider. It's not a concentrated customer base, it's repeat purchases, it's a suitable industry, there's dividend with an okay payout ratio. The growth side, simply Wall Street was saying 6% a year in the future. I want 7, or even ideally better than 10%. Current PE 26, and the growth that could go down to 19. And it's not a SPAC, it's not unprofitable, it's not cyclical. There's quite a lot of capex that eats out their cash flow from operations to get to free cash flow. I don't think I hold anything to sector off the top of my head. So that's my assessment. I hope that's been useful for you. Do let me know below if you hold this company or are thinking of buying it. And I will see you on the next one.